Stocks are wobbling, bond yields are confusing, and the headlines scream uncertainty. Meanwhile, something old, heavy, quiet, and historically reliable is stealing the spotlight. Gold. But you don't have to buy bars, pay for storage, or learn how to ship bullion. You can buy it like a stock. In this video, I'll break down the best gold ETFs for 2025, explain the real differences between them, show you the trade-offs nobody tells you, and reveal a simple approach US investors can actually use. By the end, you'll know which gold ETF fits your goals and why. Let's dive. We'll cover the top physical gold ETFs, the ones that actually hold bullion, what matters, fees, liquidity, tax, and trust structure, plus the newer options with unique features. I'll give a short, practical recommendation for different investor types: buy and hold, tactical hedge, and allocation builders. All facts are current as of October 2025. Let's start with the simple question: why buy a gold ETF at all? Section 1. Why gold ETFs? Gold is not a growth engine. It doesn't pay dividends or sales. It's insurance, a hedge against inflation, currency debasement, and times when stocks and bonds both stumble. But owning physical gold is clunky. You pay premiums, storage, insurance, and face liquidity hassles. That's where gold ETFs come in. They let you own a claim on physical bullion that trades on exchanges, just like stocks. You get daily liquidity, easy trading, and no vault to visit. Section 2, the short list, the ETFs you need to know. For US investors in 2025, 5 products stand out. SPDR Gold Shares GLD, the original giant. It's the largest and most liquid gold ETF in the world. If liquidity and tight spreads matter to you, GLD is the obvious choice. iShares Gold Trust, IU. Lower fees than GLD, still huge in assets, and a common choice for buy and hold investors who care about cost. A burdened physical gold shares, SGOL. Well-audited structure and competitive fees. Some investors prefer its custody transparency. Morningstar. Gold ETF, OUNZ, similar to a physical ETF, but with a rare feature. Investors can request physical delivery of gold bullion. That option costs more in some cases, but it appeals to those who want theoretical convertibility to bars. ETF and mutual fund. Sprott Physical Gold Trust, PHYS. Often structured as a trust with a strong emphasis on allocating real bullion to the product. It's popular with investors who value active physical backing. Note, check the listing details and premium/discount before buying. These 5 capture the mainstream choices. You get a mix of size, cost, custody style, and a few special features. Section 3, side-by-side analysis. Here's how to think about the trade-offs. Fees/expense ratios. Lower fees compound into meaningful differences over years. IU and several newer ETFs, GLDM, IUM, often advertise lower expense ratios than GLD. But remember, expense ratio isn't the whole story. Spreads and bid/ask matter for active traders. Liquidity and AUM. GLD is the giant. That means narrower spreads and easier execution for large trades. IU has the benefit of lower cost with large scale. If you trade big blocks, GLD typically has the cleanest tape. Custody and audit. SGOL touts vault-level transparency and independent audits. That's attractive if you worry about, does the ETF actually hold the metal? PHYS and OUNZ emphasize physical backing and unique structures. If that matters to you, read the provider's vault/custodian disclosures. Special features. OUNZ's option to physically take delivery is rare, but conversion fees and logistics mean most retail investors will never use it. Still, the option is psychologically comforting to some. Fund manager VanEck. Bottom line, if you want simplicity and liquidity, GLD is top. If you want lower fees for buy and hold, IU or GLDM are great. If you want audit and custody transparency, look at SGOL or Sprott's Trusts. If you want convertibility to physical metal, OUNZ is unique. Section 4, tax considerations. Taxes are one of the most overlooked but important factors. In the US, gains on investments backed by physical gold are typically taxed as collectibles when sold. That means long-term capital gains can be taxed at a maximum of 28%, not the usual 15 to 20% rate for qualified long-term capital gains. That matters if you're holding gold in a taxable brokerage account. It makes a difference to after-tax return. If you plan to hold gold long-term and are worried about taxes, Consider holding gold ETFs inside tax advantage accounts like IRAs or 401ks. Also, some products structured as trusts or closed-end vehicles can trade at premiums/discounts to NAV, and those moves can create tax consequences when you buy or sell. Always check the funds tax guide or talk to your tax pro. Section 5. Scenarios and recommendations. Okay, what should you do? Here are 3 real-world archetypes and a simple approach for each. The buy and hold hedger, long-term, low maintenance. Choose IU or GLDM for lower fees and hold inside a retirement account if possible. If you want the ultimate liquidity and don't mind a slightly higher expense, GLD is fine. These choices minimize ongoing costs and execution friction. The tactical hedger, short-term portfolio hedge. Use GLD for liquidity and the tightest spreads if you need to get in or out quickly. For intraday or short-term moves, liquidity matters more than a few basis points of expense. The physical foil, someone who cares about custody transparency. Consider SGOL or PHYS if you want clearer custody audits and a product that publicly details where the bars are stored. If the idea of converting to actual bars matters to you, OUNZ gives a delivery option, but expect friction and costs. Portfolio sizing. Most mainstream pros suggest some allocation to gold as insurance. Think 5 to 10% classic allocation for long-term portfolios, and 10 to 20% only if you're highly worried about monetary or financial risks. Heavy allocations work for some, but gold is a diversifier, not a dividend generator. Section 6. Common mistakes and emotional traps. 2 mistakes I see over and over. First, buying gold as a get-rich-quick play during a media storm. Gold is insurance. Sometimes it rockets, sometimes it sits. Second, ignoring taxes. Because of the collectibles rate, a great-looking pre-tax return can look very different after Uncle Sam. Be realistic about your time frame and reasons for owning gold. Recap. For most U.S. investors in 2025, IU or GLDM give low-cost, simple exposure. GLD gives maximum liquidity. SGOL, PHYS, and OUNZ offer custody or conversion features for those who care. If you keep gold as a small, purposeful slice of your portfolio and pay attention to taxes, gold ETFs are one of the easiest ways to add true diversification. If you found this helpful, like and subscribe for more clear, practical investing breakdowns. Drop a comment. Which ETF should we compare side by side in the next video? GLD versus IU versus SGOL, and I'll make it happen. Thanks for watching. Stay curious, stay skeptical, and protect what matters.